Hi everyone. Okay, so let's have a look at the petty cash system. Okay, so the basic principle for controlling cash disbursement is that all payments are made by check. Okay, but for some organizations, there's small little amounts that need to be paid that to go through the process of getting a check cut in order to make this payment just doesn't seem necessary. But again, we have to keep control of all of our cash. So that's when they came up with the petty cash system. So what it was, or what it is we have somebody assigned in an organization to keep track of what they call petty cash. And it's a small amount of cash that they keep in a lockbox assigned to an individual, and it's often the individual that's sitting at the front desk. And maybe there's a courier that comes in and there's a small fee attached to receiving this item, or somebody needs batteries for the clock in the lunchroom, so somebody wants to run out and get the batteries, or there's different supplies that are needed, or there's a sale at Staples, so the boss wants someone to run to Staples and grab a stapler or loose leaf or whatever the case may be. Um, so it's kept in a lockbox, and one person has control of this lockbox. And then as the money starts to run out and are getting replaced by invoices, then cash needs to be redistributed to the petty cash. So, for example, the one with the courier, somebody comes in and says, there's a fee of $3 attached to this delivery. Here is the invoice showing that it's needed. So you'd use that as the proof. So you'd put that as the receipt into the petty cash box and you'd give them the $3. Okay, so, and it still balances because if you add up the cash and include the amount of the invoice, it would still be, say, $200, which is the petty cash fund. Or maybe you send somebody to the store to pick up some coffee and batteries, and they come back with a receipt. You would given them $20 to buy it. They come back with the receipt, and the amount of change that they're giving you with the receipts equals that $20. So no matter how you add it up, it always equals a certain amount. Okay. So establishing a petty cash fund requires estimating the total amount of small payments likely to be made during a week or a month. And that's a decision that the organization needs to decide. How long do they want this petty cash fund to last before it's reimbursed? Sometimes every week is a bit much, especially where to get the fund reimbursed, you need to actually get a check and get that check cashed to be able to put cash in the petty cash box. So a lot of times it is a month. So a check is then drawn by the company's cashier's office or the person in charge of writing checks for the amount slightly in excess of the estimated amount needed, just so that you don't run out. Um, an employee designated as the petty cashier is responsible for safekeeping the cash, for making payments from this fund, and for keeping accurate records. So when the petty cash fund is created, of course, a journal entry needs to be made. We need to have in our chart of accounts an account called petty cash so that when you look at your trial balance that has all of your accounts on it, or you look at your assets on your balance sheet, there's going to be a cash account, but then there's also going to be a petty cash account. and you'll be able to see how much is going to be in that. So in this case, it's going to be $75. So for the journal entry to create the petty cash fund, you would debit petty cash, the $75, because that is the amount in that asset. And then, of course, you'd reduce the cash account by $75. Okay, so this entry would transfer the $75 from the cash account to the petty cash account. After the petty cash fund is established, the petty cash account is not debited or credited again unless the size of the total fund is changed. And that's because, again, every time you go to the petty cash box, whatever's in it is the equivalent of the petty cash fund. So the petty cashier should keep petty cash in a locked box in a safe place, and as each disbursement is made, the person receiving the payment signs a petty cash receipt or petty cash ticket. Okay, so let's look at this slide first, okay? So now it's a month later, you only have a little bit of change left in your petty cash box and a whole pile of receipts, okay? So now you know you need to get more cash in the box and hand the receipts over to the accounting department. So this is what we do. So number one, we're going to add up all the receipts. Number two, we're going to add up all the remaining cash in the petty cash fund. Number three, we're then going to calculate whether the cash is over or short to the total petty cash receipts less the cash required to replenish the fund to its original amount. So does it balance? Does the amount of cash that I have plus the amount of invoices, does that equal the original amount in the petty cash fund? So then once that's determined, and we'll go back and look at the worksheet, once that's determined, we need to record the journal entries to record all receipts in the petty cash to the appropriate expense account, and then record the cash over short, if there is any, hopefully there's not, and then the account for the reduction in cash, because we need more cash put into that petty cash box. All right, so let's have a look. So we've added up the receipts and we've categorized them. And the reason we categorize them is, again, because we need to make a journal entry. So if we have a look, we have office maintenance, we have transportation in, we have delivery expense, and we have office supplies. So our total for office maintenance is $46.50 because we had the three invoices there that we detailed. And then we have transportation in, delivery expenses for $15.05. And then we have a smaller delivery. So in this, instead of calling it transportation in, they're calling it delivery expense for $5. And then we purchased office supplies for $4.75. So once all of those are added up, we can see that we have total receipts of $71.30. That's the amount that we need to balance to. So now we have a line that's called fund total. We know the fund was originally $75. The cash we have remaining is $2.20. So the cash that's required to replenish the petty cash to the original $75 is $72.80. But we only have receipts of $71.30. So we are actually short $1.50. So something happened when we were receiving change or giving change, and we now are short by $1.50. Okay. So the fund had only $2.20 remaining. Okay. But it should have had, we only have receipts for 71.30. So we should have had $1.50 more. So somebody made an error, but we need to account for that when we create our journal entry. So we're going to go office maintenance expense, the 4650. This is coming directly off the worksheet. Merchandise inventory, 1505. It told us what account to debit. Delivery expense, $5. Office supplies expense, $4.75. Then we have the line cash over and short. Okay. But then we can also fill in the line for cash because we know to reimburse petty cash, we need $72.80. So it's at that point that from the worksheet plus from your journal entry, you can confirm that you need to debit cash over and short by $1.50 to make your debits and your credits balance in this entry. So at this point, we ran out of money quite quickly. So it's been decided that we're actually going to increase the amount of petty cash we have on hand. So instead of $75, we want to make it $100. So the way we can do this is we can either combine it with this entry to make it one big entry, or just like we did when we established the petty cash fund, we could do another entry that has just petty cash as your debit and then cash as your credit. But if you're going to combine it with the entry that you made here, we're going to put another debit called petty cash, $25, and then the amount of cash that we need to reimburse the petty cash fund is actually $97.80. Let me know if you have any questions, work on the activities, and this will help to reinforce this concept with you. Thanks, everyone.